everybody. A very good day to you and welcome to this, the fifth of Rethink's mini podcast series on UAE corporate tax. And we do hope that by tuning in every fortnight, some of the fog surrounding the UAE's corporate tax is beginning to lift. And all you can see ahead of you is the sunlit uplands of corporate tax compliance. My name is Neil Guthrie, and I'm very pleased to say I'm joined once again by Kirti Vudamoody, and we are going to be discussing the fascinating and extremely important subject of the CT implications for holding companies and SPVs.
Hello and a warm welcome to you all.
So, given that a large number of holding companies and SPVs are constituted in free zones, particularly DIFC and ADGM, we do recommend that you watch this podcast in conjunction with episode 4, where we discussed the CT implications for free zones in general, and let you know about the areas of the legislation that are crystal clear and those that are maybe quite not so clear. And we've made life a little bit easier, hopefully, for you by giving you a QR code there that you can scan, and it takes you straight to episode 4 of the podcast. And the aim in this podcast is to focus on the CT aspects of holding companies and SPVs, and not spend so much time on legal descriptions of holding companies and SPVs and the nuanced options in terms of company types that holding companies and that are available for holding companies and SPVs, particularly in DIFC and ADGM. And we leave that to the experts. But again, we made life a little bit simple by giving you a QR code for you to scan to get straight to a fact sheet on the subject from our sister company, MHQ. So let's start with a very general description of, or rather a very general definition of a holding company and an SPV. So a holding company is a legal corporation that's set up with the primary purpose of holding and controlling shares in other companies, to consolidate control under one umbrella, to limit the exposure of the group to the investment in a particular subsidiary, should that subsidiary fall into financial distress, go into bankruptcy or whatever, and provided there are no other cross guarantees within the group, then, as I say, the limit of exposure should be the investment in a particular subsidiary. In terms of an SPV, special purpose vehicle, or special purpose company as it's sometimes known, this is a legal entity formed to fulfill a very specific and limited objective, ring fencing assets and liabilities and protecting a holding company from the financial distress, bankruptcy of an SPV and vice versa, of course. Shielding assets from creditors, making it possible, indeed, facilitating bringing in investors for the specific purpose of the SPV, be that to purchase an asset, to execute a project, particularly a high-risk project, or licensing of intellectual property, or whatever the purpose of the special purpose vehicle is. So, given the UAE's commitment to being a leading global financial hub, and just the sheer number of holding companies and SPVs that have been set up in the UAE, it is really vital that we understand the CT implications for both holding companies and SPVs. So, Kirti, over to you really. From a CT perspective, what's so special about special purpose vehicles, and what challenges is the CT legislation holding for holding companies?
Thank you, Neil. That was a very detailed background. I must say the questions are very pertinent, even if they are, dare I say, a little contrived. The short answer is that the compliance obligations for the holding companies and SPVs are same as any other taxable person in the UAE. The notable differences, however, would relate to the type of income that the entities generate and the taxation thereof. As discussed in the previous podcasts, All entities will be required to register for corporate tax purposes and maintain accounting records to the requisite standard, notably IFRS or US GAAP. Free zone entities must, in addition, maintain adequate economic substance, follow arm's length principle, that is, transfer pricing requirements for the transactions with related parties and connected persons, and derive qualifying income in order to benefit from the 0% CT rate. As mentioned in the previous podcast, the vital cabinet decision defining what is meant by qualifying income is still pending.
Thanks, Kirti. So if the CT regime is the same, what are the differences relating to the types of income that typically holding companies and SPVs have with regard to the tax treatment that you mentioned? Are you referring specifically to dividends?
Yes, but not only to dividend. Given the nature and purpose of holding companies and SPVs, they generate dividend income, other profit distributions, as well as capital gains or losses on the sale of shareholdings. The CT law provides that domestic dividends and other profit distributions are exempt from corporate tax. Dividends from foreign entities and capital gains from the sale of shares, whether domestic or foreign, can be exempt from corporate tax, provided the participation exemption rules are maintained. These participation exemption rules stipulate ownership of at least 5% of the shares, holding period or intending to hold for a period of minimum 12 months. In case of foreign entities, a minimum taxation under corporate tax or an equivalent regime at a rate of 9%, and any other additional criteria as may be introduced by a cabinet decision by the FTA.
Thanks for that, Kirti. So what about other types of passive income? I'm thinking in particular about interest income, rental income. Are there specific rules for those types of income?
On that, the CT law does not provide guidance on the taxation of interest income. It is expected that it will be clarified by a cabinet decision in due course. We speculate that the classification of interest income for free zone entities could be qualified under the qualifying income, especially for the interest income from non-resident entities, rendering it tax-free. But we must wait for the cabinet decision to know this for sure. On the other hand, on the taxation of rental income, there is no detailed guidance on this yet. Same as interest income, we have to wait for a cabinet decision on this too.
Okay, thanks for that. There's still a lot to be clarified by cabinet decision, isn't there? And given that the first companies that fall into the CT tax net will have financial years beginning 1st of June 2023, it's certainly hoped that there'll be clarification in the very near future. It should be the case, shouldn't it?
Indeed, that should be the case.
Okay, moving on to another important aspect for holding companies and SPV as far as CT is concerned, that's income repatriation. What are the rules and limitations around income repatriation, Kirti?
Yeah, sure. Shareholders of holding companies and SPVs are often foreign legal entities. Hence, they would be receiving income from their investments in the UAE. As you might have heard, the UAE introduced withholding tax rate set at 0%. Therefore, there will be no deduction on any payments made to non-residents, including dividend distributions. This is, of course, a major competitive advantage for the UAE versus other tax jurisdictions. Even if the withholding tax rate is increased in the future, the UAE has a large number of double taxation treaties with other countries that can be utilized for tax planning purposes.
Thanks, Kirti. It certainly is the case that 0% withholding tax is a very attractive proposition. I suppose, though, that once it's introduced, and it has been introduced at 0%, it's easier to increase the rate of withholding tax than it is to bring it in for the first time. So I guess we need to be keeping an eye on that space, really, don't we? So what else should holding companies and SPVs be considering when it comes to corporate tax?
As with any other taxpayer, holding companies and SPVs should consider two main elements: transfer pricing requirements and general anti-abuse regulations, notably known as GAR. The transfer pricing relates to transactions with related parties and connected persons, specifically envisaging that the transactions with these to be at arm's length, and if not, adjusting the taxable income accordingly. Holding companies and SPVs may need to pay particular attention to interest payments and receipts being on demonstrably commercial terms or commercial price, arm's length price in other words. We gave an overview of transfer pricing in podcast 3, and we will return to the subject in considerably more detail in future podcasts. And on the other subject, the general anti-abuse regulations, we again introduced this concept in the previous podcast. We recommend our clients to look at the structuring or organizational changes to their businesses through these changes being implemented through the prism of GAR, as these rules are already effective from about October 2022. A reasonable defense file against GAR is to gather enough evidence not that the organizational or structural changes were made not primarily for gaining tax advantage, but rather on the basis of a compelling business case.
Thanks, Kirti. You're right to raise the subject of transfer pricing and GAR, because both are already in force, as you rightly say, and both could negatively impact a business if they're not taken into account. So let's turn to foreign holding companies and SPVs with business interests in the UAE. What aspects of the CT legislation should they be taking into account?
Well, first of all, a foreign holding company, or for that matter, any foreign entity that is deemed by the authorities to be managed and controlled from the UAE will be considered as resident for tax purposes. Being a tax resident in the UAE would mean a foreign entity will be subject to UAE tax on their worldwide income and would be fully subject to UAE tax compliance, that is, register for corporate tax purposes and submit a corporate tax return. The key decision makers, such as the directors, must ensure that the strategic decisions of the foreign company are taken outside the UAE to ensure that the company is not regarded as managed and controlled from the UAE.
Yeah, very, very sound advice there. There's an awful lot of companies worldwide registered in one jurisdiction who've fallen foul of the management and control regulations of another jurisdiction, much to their financial detriment. Well, on that note of caution, we'll pull down the curtain on this episode. We do hope that you found our insights on SPVs and holding companies to be useful. We'll be back in a fortnight's time when we'll be discussing the CT implications for foundations and trusts. But in the meantime, we wish you a very pleasant rest of the day. We hope to see you in 2 weeks' time. Thank you very much for your time, and goodbye.
Thank you and goodbye.